Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Man, are these markets messing with your investment dream? What's the deal with these markets? Gangbusters up for the first 3 or 4 months of the year, then a meltdown, choppy looking, then it starts firming up, and then it looks to crack and crater last week. But now, what's up? We're going to talk about that. We're going to talk about stocks and more stocks today, even though Don's probably opposed. And bonds, we're going to talk about bonds too, not because we're worried about being all-inclusive, but more importantly, because now bonds are relevant. They weren't relevant before when interest rates were at zero and they should have been avoided, but now they are relevant. You see, I have a dream. I have a dream today that someday securities, both stocks and bonds and even commodities, will be judged not by their brokers' underwriting and marketing, but by the content and quality of their cash flows and relative strength. I see Don smiling over there. Sorry, I had to, folks. Now, that content, that affirmation I want, and I believe you want too, is price appreciation. Because remember, price equals truth. And because it's your money, not their money, you got to pay attention or have someone that has your back that is a fiduciary. Now, remember, even though the podcast is fun and we talk about stocks and FOMO, fear of missing out, is tantalizing, risk and rules must be abided. Again, this is deadly serious for your financial health and your money. Again, price is truth, and if price isn't confirmed, it's got to be cut cold. You do not buy and hold. Price equals truth and must be confirmed so that you can hit your investment dream. All right, now, before we dive into the markets, Don calls him my man crush. I actually like him. He's the Bond King Jeffrey Gundlach, and he's a great, I don't like him because he's great in bonds. I don't really care about bonds. I care about the fact he's a really good economist, and he's been right more than the actual people who call themselves economists. But he's did this article on the 6 data points that are pointing to recession. And if you're an asset allocator, God, now I got to take a shower. It's actually very relevant for you. All right. We also have an article about Liz Ann Saunders. You don't need the Mag 7 to perform well. Okay, Liz, which stocks do we need? Just tell us then. Give us the meat. Okay. And then there's articles on the projected retirement planning for 2025, the new IRA, standard deduction, IRA limits, all that kind of stuff. They're updated. And so you can look all that in the mailbag. I don't want to slow the show down. I want to get right into the markets. And let's go to the mailbag first, and then we will go straight into the markets, all right? So this is 911JH. Good evening, Don. I keep seeing reports that Dave Ramsey invited taking Social Security at 62, my age, and then investing all of it. Your thoughts? Oh, good evening. From Don's video tonight, it seems like Wall Street is rooting for Kamala Harris. Is that true? ? Finally, do you think a Roth conversion would be advisable for me? If I were 32 years old, I'd say yes. Hope you're doing well. Best regards. Me. Hope the rest of your fishing trip was, he's a client, I know him, was excellent. Regarding Social Security, it really depends. You have to examine the variables. But I understand his philosophy and opportunity cost. If you can take the money and you don't just have to live on it and you can invest it, you can probably do better than the automatic increases with Social Security. Okay? Now, some on Wall Street, like Goldman Sachs, want Kamala, but others not so much. Goldman Sachs is tied in with the Fed, and Trump has spoken about getting control of the Fed. Interesting tidbit, by the way, little side note. Did you know that every president ever assassinated was making noise about abolishing or restricting the then central bank? We've had 2 central banks before the Fed, in case you didn't know. They both went bust. So we're 0 for 2, and now the Fed's trying to do it different this time. Anyway, regarding Roth, it all depends on the numbers again, but generally the younger you are and the lower your tax bracket, the more conversion or even a Roth contribution, if your income's low enough, makes sense. At your age, it is not as beneficial, and you have to get back your tax rate that you paid in gains, say 25%, before you're even. From that point, it is very beneficial. We need to look at your personal taxes, your personal tax rates, your expectations on future taxes, and your anticipated RMDs in the future. And you can also do in pieces over the years to control tax rates. If you are going to do a conversion from your IRA to your Roth, you don't have to do it all in 1 year. You could do it, break it over 2 years to minimize the taxes or to make sure you don't go up into a higher bracket. Folks, if you're going to do a conversion, have someone help you. It's very complicated. Let's look at the actual numbers. If you're 32 or even 42 or even 52, it can make sense if your income is not too high. Folks, listen. Just remember, I don't talk about this enough. Revere Asset does all the holistic planning. We do retirement, estate, corporate, tax. But look, no one wants to hear about an irrevocable Delaware trust or a Nevada trust or South Dakota or even offshore. I know all of them, right? Or corporate individual estate taxes, asset. It's boring. We want to hear about the next sexy stock. So that is actually what we're going to talk about. But if you need the others, reach out. All right, second mailbag. Don, I keep seeing AI trading platforms in my feed. Is it for real? Does it work? Have y'all looked into it? Seems too good to be true. Thanks, BH. Don, great question. Wall Street has been using a type of AI for years via systematic algorithms to trade every conceivable edge. Value, growth, GARP, momentum, dividend, low and high volatility, low and high beta, low and high relative strength, astrology. That's true. Numerology, time of week, month, year. Despite this, most can't beat the S&P over an extended period of time, even though they hire the smartest PhD grads. The rise of AI LLMs has taken this to another level and made it available to anybody with an internet connection. Very often, Wall Street becomes too successful and soon becomes too commonly used, and the edge evaporates. My take is that the edge exposed by AI will see the same result. Too good to be true over any extended time period. I have copied the team to add to their comments. Thanks, Don. This is me. I agree with Don. I've seen too many money shows, trading shows with all the players out there. Online Trading Academy, Options Monster, Al DiLiberto with VectorVest. All the black boxes abound, right? And many are doing small presentations with 12 chairs and only 6 are taken, claiming 86 or 92% success rate. And I'm thinking, if that were true, you would own one of the Hawaiian Islands and not teaching trade shows to a few retail investors. Look, I'm not saying that those trading software tools don't work if you master them, but it still takes work and it isn't automated. Thus far, humans 1, AI 0. At some point, it may add more value, but the real value in AI currently is doing research and admin tasks. It can quickly pull up and analyze financial data quickly to give you a summary literally within a minute or two. Cheers, Dan. And before we go to Don, I would like to get Ted's take, because Ted is really kind of the guy in Revere that's an early adopter, and he's playing around with every AI platform out there, and he's just eating this stuff up. So, Ted, what are your thoughts on the AI, set it, forget it?
So, yeah, both your and Don's responses are definitely completely valid. In terms of the AI strategies being sold online, here's kind of my reasoning with that and why those are to not be trusted. If someone really has an AI bot like a Renaissance Technologies that runs algorithms that really consistently beats the market over a long period of time, they wouldn't be selling that. Rather, they would be hoarding that strategy, and they would try to get as much money into that strategy as possible. If you think about it, an AI, an algorithm, is just printing you money. Why would you want other people to be in on your edge? So that's my take on that. On to the next thing, Dan. So I've shared that I love Perplexity, which is more of a search engine, that new age search engine. And then ChatGPT from OpenAI and Grok are two of the other ones that I primarily use. And some of the main functions I just use them with is asking for a summary of a PDF. You can upload a PDF, ask questions about the PDF, and it can spit out answers, for example, with earnings reports or 10Ks, 8Ks, 10Qs, if you are into that deeper fundamental research. You can search up news events. For example, you see a stock gapping up on huge volume from a month or so ago. You can put in the date, ask Perplexity, ChatGPT, or Grok, what happened on this date for the stock? And it'll search through what they're trained on, the data they're trained on, and spit that answer out to you. You can ask it, for example, to give you a summary of economic news or market moving events for a specific day as well. And even with ChatGPT and Grok, they're much better at coding than Perplexity, since Perplexity is more of a search engine. You can code, if you use TradingView or Thinkorswim, for example, indicators in those platforms. And aside from that, even just for life, just asking it questions, making workout plans if you're into working out, are some of the use cases I use it for as well.
So let me ask you, but if you actually have Twitter, folks, if you have Twitter and you have the blue check mark, in other words, you pay Twitter that $8 a month, I think it's $8, but pay Twitter to be verified, then don't you get Grok as part of that? You don't have to pay a premium?
Yes.
Okay.
Yes, you do.
So folks,
and if you subscribe through the online site, so not through iOS or Android, the cheapest one is $8 a month, and that is over 50% cheaper than the other models out there.
All right. Well, listen, Ted, I appreciate that, folks. If you got any questions, you can reach out to any of us. All right. Now, I have a dream. I have a dream that my money and your money, if you're a client at Revere's, is working for you and only you, and not the government, and not the brokers, and not Wall Street. So now, to get unbiased, unfiltered, red meat data and advice and market strength, weakness, and what we're doing, we're going to go to Don. Don, I set you up, man. The table's there, all the silver, fine silver's out in the crystal.
Thank you, Martin Luther Stewart. I appreciate that.
Martin Luther Stewart. I like that. I got to write that down.
I mean, I went through every gyration, Daniel Stewart King, and I came up with Martin Luther Stewart. Dan,
do you know my middle
name
is Martin? My middle name is Martin.
No, it's not.
It is. Daniel Martin Stewart. It is. I promise.
That just adds more legitimacy to your dream, I guess, doesn't it?
It's Daniel Martin Luther Stewart. That's what it is. Daniel Martin Luther Stewart. All right.
As Dan said, we only judge tickers based on the value of their returns, not on the content of their story.
Oh, wow.
I could probably clean that up a little bit better and find it. But every stock's got a story, right? That's what analysts are for. That's what marketing is for. But does the story match the stock chart? That's what we focus on here at Revere. And this has been one of the most interesting weeks from a lot of interesting weeks that we've had. These markets are not getting easier. There's an old mantra on Wall Street that you can't have V bottoms. When you're selling off, bottoms have to be a process. They have to take a couple of weeks. And an example of that is kind of what happened back in April, where we were selling off. It took 3 weeks to form a bottom before we started heading back to the upside. But here's two examples recently, back at the beginning of August, a massive V bottom off of this 3-day sell-off, which was tied to the Fed and also tied to the yen carry trade fears. So 3 days down, a slingshot back to the upside, and then went sideways a little bit, couldn't quite make new highs. And then we had a pretty harsh 4-day sell-off here as well earlier this week, or last week, sorry. and a massive early day sell-off this Wednesday. This was after the debate where the prevailing wisdom is that not that Harris won, but that she far outperformed what her expectations were. That first 90 minutes was nonstop selling, down 1.6% on the day, and then a complete 180 around 11 o'clock Eastern time. And really, we've been trending higher ever since then. So another case of a strong V bottom right here. Now, you can either argue and hold the stance that no, we can't have V bottoms, or you can pay attention to what the market is actually doing and place your, I don't want to say bets, but there is a risk every good bettor every good person who gambles has a risk management system that's part of their overall outperformance. You never bet the house on any single investment. You take the equivalent of good risk reward entries when you're picking a side, whether it's a football game or anything related to betting. But what we saw after that massive shakeout was a big turn back to the upside in the markets. And we got defensive here per our rules, breaking the 21-day moving average and the 50-day moving average. And we re-engaged per our rules, regaining the 50-day and the 21-day moving average. These levels are not any magic bullet. They're reference points from historical returns that the market does better or worse. If that does better above the levels and worse when they're below the levels, the granddaddy of them all being the 200-day moving average, where no bear market has ever occurred unless you break that level. This is why we give the market the benefit of the doubt as long as we're above that level. Another key level is the 100-day moving average, and that's exactly where we bounced Wednesday morning, and that also coincided with the 5,400 level, which provided resistance and or support over the past few months going back to June. So it made sense to bounce there. But what was surprising is the intensity of the bounce off of that level, as I showed with this 5-minute chart here. So once we started to turn back to the upside, this was also accompanied by a comment that I made. I sounded pretty bearish Friday going into the close and when I did the video. Then Saturday morning, I started doing my weekend work, and I found way more stocks that were in a really decent risk to reward position if the market would come back to the upside and show some strength. I found way more than I expected to. In creating my 21 over 21 list for the week, there was actually over 40 stocks that were really final candidates for it. I shared that with the team. Their weekend work supported. They came to pretty much the same conclusion that I did. So once that market started to move back to the upside, we just went to our list, saw what was outperforming, what was hitting a pivot, what was up on volume, whether or not the themes that we've been paying attention to were continuing to get weaker or get stronger. And we got substantially longer starting Wednesday, added more on Thursday. Haven't done anything today. We're just letting the positions that we have go higher because we are extended to the upside. This is the third day up off of that low. And but the market, as of 11 Eastern time on Friday, is not showing any signs of reversing. Then we set our targets on the next highs above, which is 56.52 and then 56.70. And if we eclipse 56.70, we're at a new all-time high on the S&P 500, and you can be bearish all you want to, but you're just arguing with what the market is actually doing in that case. So
you're arguing with price.
Yeah. So that's our take on it. It started with sometimes the indexes act a lot better than individual names are, based on what we looked at over the weekend, and I mentioned in Monday's video. Individual names were showing more potential to outperform the indexes, and we're seeing that with the indexes getting back above those two key levels, the 21-day and the 50-day moving average. Individual stocks are working, and even while we were pulling back, there were a handful that gapped up on earnings or other catalysts, and they continued to the upside, which while which while the market was pulling back is not something that you would expect to see. So there were stocks that were bucking the trend, and they've continued to work, and quite a few have joined their ranks. Not a single one of my 21-21 list broke down this week. So while the markets were down over 4.5% last week, they're gaining most of it back as of 11 o'clock Eastern time here on Friday, Dan. So we're flexible. It's okay to be wrong. It's not okay to stay wrong. And we bend like a tree in the breeze, which was something that has been drilled into my head. It's one of the Bill O'Neill sayings and the team at IBD, and it's a successful approach to the markets, and that's one that we're always going to stick with.
Yeah, and that, by the way, that was a great pick on Oracle yesterday. That was a perfect timing on that. So last week when the markets got weak, really, it sounds like what you're saying is that the larger cap, the big growthy names really came under pressure. And so the overall indices were down, but there were smaller names or other names that weren't as big, didn't have such a weight in the indexes, that actually kind of held up and did pretty well. And that's why the whole market didn't really completely collapse. And then when the market kind of firmed up early this week, it really had, when the bigger stocks started acting okay again, the whole market started acting better. Is that kind of a fair? Okay.
Yeah, and we had been pointing out for the prior 3 weeks how the RSP, the equal weighted S&P 500, was outperforming the market cap weighted.
Right.
And along with that V bottom has seen outperformance by the NASDAQ 100. You can see the relative strength line there off the bottom. So money's flowing into when the street has confidence in the market. These are the go-to names because they have such a big weighting in the indexes, and they're very liquid, and it's easy to buy them and just watch them ride higher. When you don't have as much confidence, such as where they topped on that CPI report back in July, and money temporarily flowed into mid and small cap names, you saw underperformance by the NASDAQ 100. And look how much we have some catch up to do, but this typically leads higher and it leads lower. And if this takes the reins again, this could really propel the indexes higher, because both from a relative strength standpoint and a price standpoint, we've got some catch up to play with these NASDAQ 100 names.
Let me ask you a question on that chart right there, just for the stock nerds and the chartist. So that looks like a cup and handle. But the question I have is the right side of the cup high enough, that 4085 spot 54, is that high enough and close to even enough with the 503, the left side of the cup? And is the handle of the cup too low? In other words, would that qualify as a cup and handle, or is that not performed well enough?
It is a cup and handle. You can see the way they have the pattern coded. So it wouldn't be a cup and handle if the pivot wasn't within 5 to 15% of the high. So that's okay. This handle is lower than you would prefer it to be, but again, you have to take it in context of a couple of big stocks could underperform and drive this lower, and that's exactly what happened. They'll drive it lower, but they'll drive it higher as well if money starts flowing back into them.
Okay.
And we've, the buys that we've done in the portfolio over the last couple of days have tilted toward these big cap tech names. We re-engaged with NVIDIA as it came back above its moving averages. ServiceNow, a very large software name, breaking out above its flat base. And you mentioned Oracle. They did something weird. They announced earnings 3 days ago, had their conference call, and then for some reason after hours yesterday raised guidance. If they knew, why didn't they just raise guidance during the conference call? And you can see what happens. This is gapped up like 6 or 7%, and people are taking profits on it. But we got in it yesterday on the breakout above the 160 level, so we've got some decent gains. Obviously disappointing that it didn't hold this, but two big gaps like that are if we had a larger position in this, we would have sold some into this gap up because of how extended it would have got above the moving averages. But we only, had a quarter size position in it. So it's we want our last sell to be a defensive sell, not an offensive sell. So, we're just holding the position for now. It may fill the gap, and that's disappointing. But it's
but to
you
answer
just
your
never
question,
know what's going on.
Yeah, to answer your question, why they do that, come back and clean up a week or two later and guide higher. That chart's your answer right there. They get a bigger impact when they do it after the earnings, I think. I think it's marketing.
You would expect.
Yeah,
you would expect better from a big company like that.
Right,
but whatever.
All right, what do you got next?
Let's go to Ted's got some relative strength names he wants to talk about.
Yep. So last week on the podcast, I discussed 2 relative strength names, and we briefly discussed some bonds as well. But this week, I'll just review what I talked about and then kind of bring it back to the present and talk about the current action. So the first one is CAVA. And the first sign that was screaming at us that this was a beach ball underwater is that when the market started seeing some distribution, aka some institutional selling and some deterioration in leaders, this one gapped up on highest volume ever on its earnings. And its earnings were extremely good, extremely favorable. They raised guidance and they got a lot of price target upgrades as well. Also a new IPO out of a base too. And as the markets corrected and we had a few distribution days, this started pulling back and found support right at the high volume days low, started rounding out, forming a U-turn setup, which I actually talked about on the last podcast. And so far it's acting extraordinarily well. So RS line is confirming its strength as well. I think, Don, if I'm seeing that correctly, RS line is new highs before price actually. So this is definitely outperforming relative to the S&P, and our expectation is that this should, or nothing should do anything, but this is looking like it will break out to new highs, and it's trending extremely favorably. The second name, another reason why I was bringing this up on the podcast, is ONON. And again, same thing with CAVA. As the market started seeing some distribution, ONON was breaking out of an IPO base. And I cited a couple precedents before. Ollie's IPO base and LinkedIn's IPO base looks extremely similar to this one. So we had a classic cup with handle breakout. And if you go on the weekly, you can see that even better. And then afterwards, come back to the daily. We broke out, went about 10% above the pivot, and the stats are that about 50% of breakouts do retest and even shake out the price at which the pivot is. And so that's just the line drawn across the tops. So that's exactly what happened. The character of the stock, it can have some nasty shakeouts, and that's what it had. It closed strong, put in some few tight days if you're going back on the daily. And as the pressure of the markets lifted off, I've talked about this before, we've all emphasized this. It's like a beach ball underwater, and it's so far exploded into new highs in two quick days. This one, 300% year-over-year earnings growth, 27% revenue growth. Talked about the fundamentals before, and they have new initiatives like with Zendaya and other famous celebrities promoting their products. And then their Paris store also opened, which is their largest retail store in the world. So that should continue to drive more revenues and growth. And that is what the chart is confirming as well. And that is what we aim to do at Revere, which is look at the chart, look into the fundamentals, and potential future growth areas, and then align that with the chart. And finally, the third name is a new name, CPNG. This is a big Stanley Druckenmiller name. He owns a bunch of this in his fund. And this one has been forming, if you go on the weekly, a really nice bottoming base. And it's really finally starting to poke its head out from a cup with handle. And there's some classic VCP characteristics within this base as well. And the reason why I'm bringing this name up is because during the recent pullback, CPNG held some key levels, some key moving averages, and only corrected 7%. And usually these growth names correct 1.5 to 2.5 times the general market. So for the S&P to pull back like 5-ish% from the highs, it's doing quite well relative to that. Because this is still in a bottoming base, that RS line isn't just zooming into new highs, but on this right side, it is breaking out and forming higher lows and higher highs with price as well. We would definitely like to see that RS line get back above those base, like on the left side, the base highs. But for now, new 52-week highs, always a positive. out of a bottoming base as well. So pretty quick segment. Didn't want to just leave my commentary on CAVA and ONON in the ether. I think it's pretty constructive to review previous topics we've talked about and see how they're playing out in real time. And I'm sure down the months into the future, we can come back to this as well and see how these stocks have performed.
Ted mentioned VCP. That stands for Volatility Contraction Pattern. It's a Minervini term. He's gone into detail on it on prior podcasts, but basically what it is just what it is, a contraction volatility. It's also accompanied by a contraction in volume, and you saw that late August before this big day up. Nothing's ever easy. Came up to the highs. Notice, though, the M in market. The market was still pulling back. So what did it do? It gave back those gains over the next 3 days. Beach ball underwater, the market makes a bottom, and you can see what this has done over the past 5 days, including the break above the level that it had been sitting on as part of this second VCP that you could argue that it made with declining volume in here, and now breaking out to new highs. So,
can I add one more thing, Don?
Sure.
So if you look at the quarterly earnings and sales, it's not too impressive, right? You see minus 13% year over year right now, but the revenues are growing at a decent rate, about 25%-ish. But if you look on that top left area of Don's screen, you see 8,382% expected growth in 2025. And so moving into new 52-week highs out of this bottoming base, perhaps the stock is discounting future quarterly growth. And so now our job is to, of course, trust the charts first and see if the fundamentals come into the markets and if the fundamentals align with the price action as well. And this is another thing. We talk about breakouts on charts, but you could also talk about breakouts on fundamentals as well. If you look at the previous years, it was almost all negative or like barely a few dimes. And now we're finally getting that half a dollar figure now. So that's another thing I want to just point out.
Okay, let me. Go ahead, Don.
That was a miss on their earnings, and as Ted pointed out, solid 20% growth in sales 4 quarters in a row. That miss on earnings, they had a big gap down on their earnings report, but look where it closed relative to where it opened at the top of the range after a massive shakeout that set the bottom of this flat base and has showed relative strength since then. And yeah, this is exaggerated a little bit because it's 54 cents versus a negative penny versus 2024. But
Right.
if you go back 2 years, it's still a 50% increase relative to 2022, or 100% increase relative to 2022. Yeah. And also notice insider buying. There's a lot of reasons why insiders sell stocks. There's only one reason why they buy them, and that's because they have confidence in the company and what they're expecting the stock price to do.
And so I'd like
just
to point
one more.
Go ahead. Well, I'd like to point out one thing. If you look at that 8,300% growth, they think that revenues are going to go up by 8,300% in 2025.
No, not revenues. That's EPS.
Earnings, Dan.
That's EPS.
Okay.
That's earnings per share.
Okay, so they're saying that earnings is just going to absolutely explode. Now, here's the thing. That's great, and those are great fundamentals. But I want my investment to have confirmation. I want the chart to reflect and confirm that they believe those numbers. I mean, that really is the bottom line. So at Revere, we're screaming down. I mean, we're, looking at all these charts, looking at all these stocks, and we're screening for fundamentals. And when Don said he had 40 stocks on his screening from earlier today, that means those are the 40 stocks that cut the fundamental, that had good enough fundamentals to make the cut. Then he goes through there, and then he goes through those 40 stocks for charts, technical, for timeliness. Is that kind of accurate, Don? You want to add anything on that?
It is. Yeah, we demand fundamentals from anything that we are going to consider buying. Yeah, unless it's a turnaround story.
Or it's got huge revenue.
Like Starbucks right now,
Yeah.
Starbucks got, but here's what we look for. The biggest letter after the M in market is the N in Cancelim. Does it have something new? Starbucks fundamentals are terrible right now, but they just got a new CEO that has turned around Taco Bell, turned around Chipotle, and now is at Starbucks. And let me show that chart real quickly.
I think he was a CEO that when Taco Bell had that little Chihuahua, you get on Taco Bell, in the rear mirror of the car. Yeah, he started that whole Chihuahua thing. Yeah,
right. And just one last thing to add of like all of our commentaries, we're primarily zoning in on changes in character. And I think that phrase can really sum up of what we do at Revere, how Don talks about the markets. We're just looking for changes in character and then playing it day by day and managing risk.
That's
sometimes hour by hour, such as the changing character.
Yeah, even hour by hour.
No, 2 days ago.
Yeah, 11 a.m. Eastern time on Wednesday into the close, and now following up on Thursday and Friday. So,
that market was down like what, 400 or 500, and then it was what was the range on that day?
It was down 1.6% and ended up over 1%. And it's only the last time that this happened was the low in 2022 in October. The last time the S&P was down more than 1.5% intraday and ended up more than 1% to the upside was the October low in 2022. We talked about this on our one of our morning calls, and I remember Alex being on the call that day, and we were completely out of the market. We were under the 200-day moving average. We were in a free fall in the indexes. Let me go back to there. Let me go back to 12/31/2022 on the S&P 500. And it was this day right here. Look at how we were selling off. And CPI came in that day, and it was hotter than expected. And we were like, good, we're positioned to the right side. We gapped down. I remember Alex saying, we have been selling off. Don't be surprised if all the bears are out now. And, that's exactly what happened that day. That put in the low in early October on 2022, and that kicked off a decent rally.
That's absolutely right. So I kind of want to go into that because, I want to, earlier I talked about the 6 signs recession is near by Jeff Gundlach. And the reason that I want to just go over this very quickly is because, folks, you're going to hear a lot of news coming up in the next month or two, especially with the political environment and the election. And, obviously the conservatives and Republicans are going to say the economy's going into recession, which it probably is. But regardless, they're going to be hitting that, and they're going to be instituting a lot of fear. But the stock market is actually setting up. So just because we may actually truly be heading into a recession, and it may be just shallow, maybe quick or a blip, who knows? The markets actually can rally right when you start going into the recession. A lot of times the sell-off occurs before, and you'll actually start having a rally before the recession ends. But in any event, very quickly, this is the 6 signs. Yield curve disinverting. Folks, the recession starts when the yield curve disinverts, not when it's inverted. It just disinverted last week. Consumer confidence deteriorating after going sideways. Front edge of a recession is what he's saying. Leading economic indicators. They've been negative for years, but he said predicting a recession in manufacturing is kind of hard because COVID kind of skewed the numbers and it didn't make it consistent. But he said under the hood looks a bit harrowing for all these leading indicators. The only 2 components, the credit index, meaning available credit, and stock prices were up in any statistically significant manner. Everything else, he said, looks negative. What they call dispersion in leading economic indicators is back to negative. So you had 6 months positive, 4 months negative, but the negative outweighs the positives in magnitude and number. The unemployment trends, Powell said labor supply and demand is in better balance now. What that means is people are going out of work and they're slowing things down. But Gundlach says, no, the trend is troubling. Listen to this, folks. I've said this on the air for the last 2 years. Remember the Kofall curve. A government job is not equal to a private sector job. He said declines in civilian unemployment for the last 2 years. That means that the jobs, almost all the jobs it created are going to be public sector jobs, okay? And it takes private sector job tax revenue, your income off to pay for the government salary. That's why a private sector job is better than a government job, because it takes private sector jobs to pay for the government jobs, okay? It's not sustainable. All right, let's see, what else? He said that unemployment has risen above its 36-month moving average for the first time since 2020 post-COVID. Strong evidence we're at the front edge of a recession. One data point says we're 4 months into it. And this is his quote. I will say the history books will say that in September of 2024, we were in a recession, meaning looking back. Last two, manufacturing labor weakness, average weekly hours worked in manufacturing, clear downtrend below their 5-year moving average. There's an old adage, he said, first they cut the hours, then they cut the bodies. So he said there's been enough decline if you look at the past recessionary periods. Lastly, the federal budget deficits. He said they worsen during recessions, but we're already at 5.5% of GDP. That's bad, and it's going to get worse. So you're going to hear those data points because he's on the front edge, and he's like we looking at stocks on the front, in real time. He's looking at this stuff in real time, and his data, he's Johnny on the spot looking very quickly. That these data points are going to start being filtered out in reports and media and be disseminated. And in the next couple of weeks, they're going to start scaring you with recessionary talk. I'm not saying we are not going into recession. What I'm saying is that doesn't mean the markets will necessarily go down, at least right away. That's why price is truth. So what's your investment dream?
Well, his Atlanta GDP is at 2% right now, so he's got a long way to go for this quarter. If the definition of GDP or a recession is 2 consecutive contractions, we're nowhere near that.
Well, yes, but what he's saying is also, if you've read some of his other stuff, he's saying, look, that's the GDP now, but then they'll have revisions. Now, Atlanta GDP now is pretty good real time. So, I agree. I don't know whether we're going to recession or not. I'm just telling you a lot of numbers look slow. And look, they revised those jobs numbers down by 1/3, folks. 1/3 of all jobs created this last year, complete fiction. Didn't happen.
Yeah, and the market's higher since then. So.
No, exactly, and that's my point. Exactly, Don. That's my point. So what I'm trying to tell you as the investor, if you hear the R word or you hear them trying to instill fear, have no fear. Revere is here to watch out for your money. I love that, Don. That's perfect. Anyway, folks, follow the charts.
Before you close, Dan, I want to point one thing out, that bringing up this monthly chart to point out that that low. This once we talk all the time, mostly on a daily and weekly chart, about the 40-week and the 200-day moving average. This is a monthly chart. Once you're under and you're in the bear market, you start thinking, well, where's a possible spot that we could bottom? This green line here is the 50-month moving average. That's where we bottomed in 2022. We had an undercut and recovery of that level in COVID. In the 2018 bear market, this is exactly where we bottomed. This 2015 pullback, that's exactly where we bottomed. And this is where we kind of formed a bottom in 2011 as well. So the 50-month moving average, it's a much longer term. We don't talk about it a whole lot. But once you get to that level, start thinking about whether or not support is going to come in, and the worst of the selling may be over.
50-month moving average. That's a pretty long term, isn't it?
It is. Yeah.
All right. Well, folks, listen, I hope you have a wonderful weekend. If you like what you heard, please tell a friend, tell a neighbor so they can hit their investing dream too. Just send them to the right-hand corner of our website, revereasset.com. There's a subscribe button. They can put their name and email address in there, and they'll get this podcast delivered in their inbox every Saturday morning, and they'll get our daily market insight videos. We do a short video on the market conditions and what we're actually doing in client portfolios every day the market is open. We're the most transparent advisor that I'm aware of. Now, if you go to YouTube and just search for Revere Asset, that's it, just Revere Asset, and you hit subscribe, this will go to your inbox within an hour after recording. We're recording the show a little early today because I've got some commitments. We're recording at 9:30 Central. This will probably be out by noon Central on YouTube. So if you're a stock nerd and you want your stuff early, subscribe to YouTube. Next to the subscribe button, there's a contact us. You can send me an email, and you can just send it directly to me, dan@revereasset.com. And you can always, always, always call us old school at 855-REAL-WEALTH. Folks, we'll talk to you next week on Your Money. Not their money, your money.
Because it's not about how much you make in the markets, it's about how much you can keep.